to calculation. So get out your past papers. We are starting with past paper straight. And I wish to start with December 2022. Question 3. So open that question. It's in page number 16 or page 15. Be there. So I believe everyone is there, and I will wish to read. So it says, H Limited, a public limited entity, operates in the information technology sector. It has made several investments in other companies within the industry, which has earned it market leadership in the sector. The following draft financial statements for the year ended 31st October 2022 relates to H Limited and its investment companies. So we have the statement of profit or loss and other comprehensive income for the year ended 31st October 2022 for H Limited, S Limited, and L Limited. So also down there we have the statement of financial position, as you can see. So let's go to the additional information. Additional information. Number 1, H Limited acquired an 80% ordinary shareholdings in S on 1st November 2019. Remember, we are in 2022. So S was acquired on 1st November 2019, when the retained earnings of S Limited stood at 340 million. The acquisition consideration comprised cash of shillings 1830 million. So that's the consideration. The fair value of the identifiable net assets of S at acquisition date was shillings 2440 million. The excess of the fair value over the carrying value was due to an unrecognized brand whose remaining economic useful life at the date of acquisition was 5 years. M Limited is the main competitor of H Limited, and on 1st May 2022, M Limited and H Limited each acquired 50% of the 200 million ordinary shares of shillings 10 each in L. So there's another company called M, which is not part of this one here, but M is a competitor of H. H is the parent company in this context. So M and H acquired 50% each in L, which we are seeing there. Okay. The consideration paid by H Limited consisted of cash of shillings 15 per share and also a 1-for-2 share exchange when the market price of H shares was shillings 20 each. M Limited also paid 15 per share for the interest, but did not issue any shares to the owners of L Limited. The ordinary shares of L have 1 voting right each. Upon the acquisition, so up to the stage where we are, L is a joint, let's just call it joint venture. L is a joint venture up to that stage because of the 50%. H having 50% qualifies L to be a joint venture up to that stage. Correct. We proceed. We proceed. Upon the acquisition, H Limited had a contractual right to appoint 60% of the board of L Limited, with the remaining 40% appointed by M Limited. M Limited and H Limited each appointed one member to L Limited senior management team. It is the senior management, the manager appointed by H, who makes the key decisions regarding the development of L Limited's new technologies. Its principal revenue stream, the market it will operate in, and how it is financed. The fair value of L Limited net assets approximated their current values at the date of acquisition. So now, that one has now changed things again. I told you during introduction, the question is there. I told you during introduction that you only consolidate for an investee company if it is a subsidiary. It qualifies to be a subsidiary at 51% and above. However, the parent can still consolidate for the investee company even if they have less than 51%. Like in this case, L, we are going to consolidate for it, though it was a joint venture. Actually, it's a joint venture, but when you check the agreement they have, number one, H is the one appointing 60%, the majority of the board members. The key decision makers, the manager, is being appointed by H. So by that, qualifies that company to be a subsidiary, even if the percentage is below 51%. Kindly take that into consideration. So L is going to be a subsidiary. But if that provision was not there, then L will be treated as a joint venture, in which case we were not supposed to consolidate for it. But because they are appointing the majority of the board members, that one qualifies L to be a subsidiary. So L is going to be treated as a subsidiary, but at 50%. Correct. We proceed. H Limited has a policy of measuring the non-controlling interest at fair value. The non-controlling interest in S Limited had a fair value of shillings 970 million at 1st November 2019. That is S, okay. During the year ended 31st October 2022, S Limited sold goods worth 400 million to H. S sold to H Limited. S Limited reports a gross profit margin of 25% on all its sales. 20% of these goods remained in the closing inventory of H. That is unrealized profits. As at 31st of October 2022, no impairment had arisen in respect of goodwill arising on the acquisition of S Limited and L Limited. So no impairment. None of the group companies paid dividends during the year ended that, fine. S Limited had not issued any ordinary shares since its shares were acquired by H. Perfect. Required consolidated statement of profit and loss and other comprehensive income for H Group for the year ended 31st October 2023, 8 marks. Then consolidated statement of financial position for H Group as at 31st October 2022. Lynn, I hope you got the question. December 2022. That is where we are. So, there are some small workings which zatushika tu hapo mbele. Hatutaendelea mbali sana. So there are some workings which I always want us to take into account. One of the main working here is the goodwill. So I would want us to calculate goodwill arising on acquisition for both S and L Limited. So let's have that. So say there, goodwill. So that is working one. Call it working one. So working one, goodwill. goodwill on acquisition. This is our first question, so the speed might be quite moderate. The speed might be quite moderate. So goodwill on acquisition. Goodwill on acquisition. So we'll check goodwill on acquisition both for S and L. So have here S limited. Also have here L limited. Of course, shillings are in millions. Right, that's the one. All right, so purchase consideration. Purchase consideration. That is the start point. That is the start point. Purchase consideration. So purchase consideration, kindly check non-current assets. Go to the balance sheet under non-current assets. Check non-current assets in the balance sheet. So under non-current assets, I hope you are able to see investments in S limited and L limited. So whatever the investment in the books of H, those are what they paid to acquire those companies. So in S, I'm seeing 1830. Then in L, I'm seeing 2500. I hope you can also be able to see them. Then you add the fair value. So add fair value of NCI. This is going to be full method. So add fair value of NCI. Add the fair value of NCI. So NCI, check note number, I saw it where, note number 3 or 4. Uko, not 3. H limited as a policy, I hope you are seeing it. H limited as a policy of measuring and controlling interest at fair value. The non-controlling interest in S limited had a fair value of 970 million. So bring here 970. That one has been given. But I'm not seeing them giving us the fair value of L. L, they are not giving us the fair value, but we can get, there is no problem. There is no problem with that. You can get if they don't give, because you know they have said H limited as a policy of measuring and controlling interests. That S is very important. Non-controlling interests at fair value. Then they are only giving us the fair value of NCI in S. So we have to check L as well. So can you go back to where L was acquired? Check paragraph 2. No, just paragraph 1 and 2. M limited is the main competitor of H. And on 1st May, M and H acquired 50% of the 200 million ordinary shares of L. Fine. The consideration paid by H limited consisted of cash of shillings 15 per share and also a 1-for-2 share exchange where the market of H was shillings 20 each. Hiyo yote imeshatupea hiyo purchase consideration of 25. Even if you prove, you just get 25. If you take the 15 per share and 1 for that, those stories, that is 25. M limited also paid shillings 15 per share for the interest, but did not issue. So for M, we don't even need. So what will happen What you need to do is very simple. Check the value of the shares, ordinary shares acquired in L. Then you take 50%. The minority in L will be having 50. Because parent is having 50%, so minority will also have 50%. L qualified to be a subsidiary. So parent will be having 50, minority will also be having 50%. So to get the value, the fair value of minority on that date, just check the value of shares in L on the date of acquisition, then you multiply by 50%. As simple as that. So check for me the equity. If we go to equity in the balance sheet, go to the equity in the balance sheet. But that one is going to be a very long process. Because those are the total shares. It will be this way, very simple. It will be this way. So fair value in L will be, they gave shilling 15 per share, and also a 1-for-2 share exchange. So it is 1-for-2. We want to check the shares which were given. 1-for-2 times, can you check the number of shares in L, the ordinary, under equity? Ordinary under equity, when you check, you will see 2,000. You will see 2,000. So they gave 1-for-2 share exchange. So those are the shares which the parent was giving out. Hey, this one we have to be very careful then. So those ones will be 1,000 times the market price. Market price of the shares. No. Just a minute. That paragraph 2, if I joke with it, itatuletea shida. Kidogo tu, just 1 minute. The consideration paid by H consisted of cash of 15 per share and also a 1-for-2 share exchange at a market price of 20. Fine. So parent acquired 1-for-2. Which is then 50% of that. We have to be, yes, that is okay. The way they have structured that question is what because I'm not seeing the market value of the shares of L. That is what I'm trying to check so that we don't get it wrong. The consideration paid by H consisted of cash of 15 per share. Correct. So to know the number of shares, I think I get this, will be, they gave 1 for every 2 times, the 2,000 is in monetary, but check the par value. The par value is shillings 10. Check under equity. For fair value, if you have to just check under equity, the par value was 10. So to get the number of shares, you will take 1/2 times 2,000 divided by 10, which will give you now the number of shares. Then they were paying shillings 15. So the parent paid shillings 15 per share, which is still 50%, whichever 50 it is. So there is no problem because even NCI went with a half, 50-50. So how much is this? That one will be the value of the minority because it is 50%, it is 50-50, half. So that is what should go to the minority. So you take the 2,000, divide by 10 to get the number of shares, which is 200. 2,000 divided by 10, 200. Then once you get the 200 divided by or times 50%. I think I'm not even supposed to bring their half. That half is the 50%, then 10 shillings 15. Yeah, that is okay. How much is that? How much is that? Or I could have brought it this way: 50% of the shillings 2,000 divided by shillings 10 each. Then these shares, they paid shillings 15. Whichever sounds for you better. Because in L, parent has 50%, minority also has 50%. How much do you get to that respect? Vera, 1,500. So this one here comes to 1,500. Pick whichever makes you happy between the two. Mute yourself, Nabuti. Then you less. Before you less, you can add for me the two. When you add, what do you get? Give me the two answers. Then we less the net assets, then we are done with that goodwill. The first one comes to 2080. 28, 4,000. 28, 4,000. Then you less net assets. Net assets acquired. Net assets acquired. For S, check note 1. Check note 1. Additional information number 1. Additional information number 1. They said somewhere there that H acquired 80% in S on 1st November. When the retained earnings of S stood at 340, the acquisition consideration comprised cash of 1,830. The fair value of the identifiable net assets of S at acquisition date was 2,440. So this was 2,440. You subtract that. Jacinta kidogo. Then in note number for L we check. I saw it in which notes? I saw it in which note? For L, where is L? Story Papa me. Upon acquisition, had 60%. Those ones we don't want. Those key decision making is not our concern. If they are not given, then we can calculate for ourselves. Have they mentioned the net assets of L on the date of acquisition? L on the date of acquisition. As you check, allow me to answer Jacinta. Jacinta is asking, is this one 750 or 1,500? You gave me the answers, but I can confirm. That is 50% of 200, which is 100 times 15. Jacinta, it is 1,500. This is 50% or their half of, we divided by 10 to get the number of shares. Remember, 2,000 is in shillings. So 2,000 divided by 10 is 200. Half of 200 is 100 times shilling 15. It comes to 1,500. Okay, good. All right, so we are checking the net assets. The net assets on the date when L was acquired. When L was acquired. So if they have not given, then we have to calculate. I'm not seeing it anywhere. So we need to calculate the net assets on the date of acquisition of that company, which is taking us outside kidogo. So when they take kidogo, you pay net assets, L limited. If they don't give, then you can always determine it for ourselves. And which, of course, in most questions, they don't give you. This one was, you are lucky, it was given direct. In most instances, they don't give, and you need to get. So if you have not been given the net assets, then you check the equity components. Check the equity. Equity components are the net assets. So go to equity. There is ordinary share capital of L. Ordinary share capital of L is 2,000. I hope you are able to see that. Ordinary share capital of L is 2,000. They did not have share premium. They don't have revaluation, but there is retained earnings. There is retained earnings. But now the retained earnings, listen to me. Retained earnings, you check on the date of acquisition. Don't take that 2090. You know, shares, they will not change, not constant throughout. But profit keeps on changing. So if you pick this profit, you will be taking the profit in 2022, which is wrong. Goodwill is supposed to be calculated on the date of acquisition, which was when? Check when L was acquired. Note number 2. It was acquired on 1st May 2022. And you see we are closing books in October. So we have to get the profit on the date of acquisition. So in the balance sheet, at the end of the year, you know balance sheet is always done at the end of the year. They are giving us retained earnings of 2090. That is the profit they are giving us. And that profit is on the dates when we are closing the books on 31st October. 31st October. But acquisition of L took place somewhere there. Which date? Which date was this? 1st May. 1st May. So we need the profit on this date. Goodwill is calculated on the date of acquisition. So you need to calculate to determine the profit on this date here. It's very easy. So what you do, check for me P&L, their profit account. Can you check profit account? Profit for the year for L. How much are you seeing? I just want to see whether we are together. How much is the profit for L for the year in the P&L? Which you can be able to see. How much profit did they report for the whole year? Good, good, we are together. For the whole year means from the start of the year to the end. So for the whole financial year, they reported 860. So if we want this stage on the date of acquisition, it is simple. Just take for me the period from here to here. From May to October, how many months are those? From 1st May to 31st October, how many months? How many months? 6 months. Mercy? 6 months. Good. So this is 6 months. This is 6 months. So it means this 860 you divide by 2. Take 860 divide by 2. So if you divide by 2, it means here is 430. This is also 430. So to get the profit here, take 2090 minus the 430. So 2090 minus 430, you will get the profit on the date of acquisition. So if you're not given, this is how we normally get that profit. And we are doing this because the profit must be determined on the date of acquisition. But we have been given at the end. You know, balance sheet is closing. So you cannot work with that profit in the balance sheet. Profit, always use the one on the date of acquisition. So take 2090 minus 430. What do you get? What do you get? What do you get there? 2090 minus 430. 1660. Thank you. 1660. So it means the retained earnings will be this way: 2090 minus 860 times 6 over 12. That is how we have gotten that 1660. 1660. So it means the total net assets on the date of acquisition will be 3660. 3660. And that is what we bring here. 3660. You subtract. The difference is goodwill. So the difference here is goodwill. So give me goodwill in each case. Give me the goodwill in each case. That is good. Well, teacher, but we were able to come up with it. So give me the two goodwills, Vera, 360, and the other one. Vera, you 2340 is in mingi. You need 4,000 and 3,000. Here's the figure. 360 is reasonable, but this other one, Mercy, 360 and 340. Yeah, for Palm Hilda, 360 and 340. So those are the goodwills which will go to the balance sheet. It's good to know how to calculate goodwill. In this question, it was not required. It will not require that of but I will always want you to know how to calculate goodwill, because nowadays now I'm a student, calculate goodwill. So I want you to know how to go about it. Good. All right, that is done. Something else I want us to check is what we call, no, before I go to unrealized profit, I wanted us to check unrealized profit, but there is something in note 1. There is something I saw in note 1 which will be very useful to us. Check note 1. They said Health Limited acquired an 80% ordinary shareholding in S on 1st November 2019 when the retained earnings of S stood at 340. The profit on acquisition was 340. The acquisition consideration comprised cash of 1830, fine. The fair value of identifiable net assets on acquisition date was 2440, the one which we have just used. The excess of the fair value over the carrying value was due to a recognized brand, whose remaining economic useful life at the date of acquisition was 5 years. So they are saying there is a brand, and that brand we are not being given. They are saying that brand is the excess amount between the fair value of net assets and the book value of the net assets. So it means we need to get, for us to get the brand, you get the book value of the net assets. And please, any moment I'll be talking of net assets, I'm talking of the ordinary share capital, share premium, retained earnings, revaluation. Those are what I'm talking about. So we need to go to the balance sheet. We add the book value of ordinary share premium, retained earnings, revaluation. Then we compare with this 2440. The difference is the value of the brand, which they are talking about. So I don't know whether to call it working two. Yeah, we can call it working two. Fair value of the brand. Fair value brand. So fair value of the brand, you will take fair value of the net assets. Fair value of the net assets, they reported to us 2440. And you kitu nakwanga very common as well. They will always give you the net assets, then they tell you difference is a brand or any tangible asset. So fair value of the net assets is 2440. Then book value, carrying amount of the net assets. So carrying amount of the net assets, I want us to add we add the ordinary, the share premium. In S, now we are in the books of S. So when you check ordinary, ordinary share capital is 1,500. I hope you are seeing it in the balance sheet. Kindly be with me. Ordinary share capital is 1,500. Share premium, I'm seeing 500. Revaluation, they don't have. Retained earnings, don't use the 2070. Retained earnings you use on the date of acquisition, which in note 1, on the date of acquisition, retained earnings was 340. Like that. So in your books indicate ordinary, share premium, retained earnings. Retained earnings must be on the date of acquisition. On the date of acquisition. So how much do you get when you add the 3? So that we get that carrying amount to help us get the brand. What you are getting 2340. So the examiner is saying the difference between the fair value and the book value is a brand. So there was a brand. So the book value of the brand is how much? 2440 minus what you have gotten. The fair value of the brand comes to kwani mmekuwa slow? Naonanga nikigeuka napatanga mmeshanipea answer. So fair value of the brand is 100. It's 100. Then that brand, they have said we should amortize it. It is subject to amortization because they have said the remaining economic useful life at the date of acquisition was 5 years. So amortization of the brand, it will help us. So amortization will be the 100 divided by 5 years. So that one is 20 per year. It will affect our profit during consolidation. So that brand is to be amortized over a 5-year period. Good. In fact, we are even ready to start presentation, but I want us to calculate the unrealized profit. Unrealized profit rafiki yetu wa karibu sana. So I want us to calculate working 3 UPI. Unrealized profit on inventory. Ama niandike for the first time, hata niandike in full. So unrealized profit on inventory. Unrealized profit on inventory. So UPI is equals to, I want you to calculate it for me, using note number during the year. So using note number 4. Yeah. Can you use note 4 to tell me how much is unrealized profit? I'll be very happy to see the unrealized profit coming from your side. Can you try it out? Then you give me the answers. Unrealized profits. Using the formula I gave you yesterday. I know you have gotten the answer, but now people are waiting for others to confirm. You just give me what you have gotten. You better get it wrong. It's our first question, so there is no big issue. You better get it wrong, then correct the vision. How much is the unrealized profit using our formula for UPI, which we discussed yesterday. Use note number 4, additional information number 4, calculate that. Aya, Lynn amesema liwe liwalo, answer is 20. Trufosa has confirmed, Hilda has confirmed. Those 3 people cannot get same wrong answer. That is close to impossible. So let me just confirm. Unrealized profit, you take the profit margin. So profit margin, they said is 25%. So 25% times unrealized is based on the goods which remained. So they said 20% of the goods remain. So you will take 20%, they sold 400. So 20% of the 400 remained. Unrealized profit is based on the goods which remain. So 20% of 400 remain. Then they had sold them at 25% profit margin. So that one is 20% of 400 is 80. Yeah, that is 80. 25% is like a quarter. A quarter of 80 is 20. So that is correct. So unrealized profits, we have reported 20. We have reported 20. Good. There is no need for me to tanga huko nikitafuta workings. We are ready. We were even ready before we started. So now, the only thing I want us to do, we are starting the consolidated P&L. In the exam, before you start consolidated P&L, you be very careful. Very, in fact, very, 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 very careful with the period. Period can mess you up. So you must draw this number line. Please draw it with me. The financial year is ending on 31st October 2022. For the financial year to end on 31st October 2022, it must start when? What is the start date? Those small things I'm asking are very critical. What should be the start date? It ends on 31st October 2022. So the start date is Hilda, 1st November 2021. Yes, check tomorrow. It can bring you problems in counting the months. So check tomorrow. 31st October, tomorrow is 1st November. Tomorrow as per this question, 1st November. So you backdate. So this is 1st November 2021. But when was S acquired? The reason why I'm interested in those dates, in case a subsidiary was acquired in within the period, then during consolidation, P&L you only take for the post-acquisition after. So you prorate the P&L. You don't consider income and expenses in full. So when was S acquired? In note 1, S was acquired on 1st November 2019. So 2019 was before this. So it means when we are starting this year, S was there. So S is equals to full year subsidiary. S is a full year subsidiary. Let's go to L. L, we had already checked. It was acquired on 1st May. It was 1st May, first May, but it was 1st May 2022. When we counted this, we saw 6. So for P&L, you will only consider income and expenses of L from this period to this period. So L is equals to 6 months. 6 months subsidiary. Though at 50% it was a joint venture, but there are some conditions which qualified it, uplifted it to be a subsidiary, appointing the majority of the board members made it to be a subsidiary. So now, how will our consolidation be? How are we going to consolidate consolidated profits stock loss? CPL is the consolidated profit stock loss. How will it be? It will be, you will consider H in full, that is income and expenses of H you will take in full, plus S in full, but for L, you will take 6/12 times L. So L, you take income and expenses for 6 months. When we go to CSFP, consolidated statement of financial position, that is the balance sheet. Ama mfike hapo kwanza nisikuwe na mbio yenye haina maana. Consolidated balance sheet, you will consider H full, S full. You cannot apportion assets, provided, now scale your rule, provided the company qualified to be, at the end of the year, was a subsidiary, then you consider it in full. So L, you will consider in full. You don't apportion asset. Unachukuaje motor vehicle at motor vehicle for 6 months? It is impossible. So once a company qualified to be a subsidiary, provided it's a subsidiary at the end of the year, you don't bother, even if it was acquired in the morning. What were you acquiring? So you won't acquire those assets. So asset will be cut at asset nusu. What you can apportion is the expenses and income. Otherwise, assets you consider in full. So this one tends to be very one of the critical, to me, actually this is the most, what are the workings? These workings, you will even find many people are not getting, but there are some tips you can get without, because there are things inside the question which are not having any issues. So once you analyze this question here properly, you will get some marks during presentation, because there are some items there which don't require adjustments. But if you mess here, you see like P&L, you go and take L in full, you get 0 in the P&L. So you need to understand that point very well. So now let's do the consolidated P&L, unless someone has a question. Unless there is a question. So in our presentation, right there, the name of the parent. So you write H group. H group. Consolidated statement of profit, stock loss, of course, another comprehensive, just the same thing, for the year ended 1st October 2022. So you will maintain one column, shillings in million. All right, so we are good to go. So when you want to do consolidated P&L, that one they are provided. Stick to it, top down. But now you make adjustments where necessary. So we start revenue. So there is revenue. Now, since all of them are to be added, no problem. 8460 plus 3880 plus 3200. But now 3200 times 6 over 12 times 6 over 12 minus. Pick up kwanza ndio niwaambie hiyo mambo ya minus. So you add the three first. 8460 plus 3880 plus 32 times 6 over 12. So music or say odd mass, it's good to start with the one you are multiplying. 6 over 12 times 32 is when you add this other one. Then please revenue lazima mpate kwa mtihani. We only subtract one element during consolidation. You subtract the goods they sold amongst themselves. Any internal sale you eliminate. It is not a sale per se. Now, make for revenue. So there was that sale of goods, the one which was in note 4. They sold goods worth 400. Don't even bother about the profit, the what, no. Subtract that amount the way it is, the entire 400. So the internal sales was 400. You eliminate in full like that. So can you consolidate? So the 400 is the intergroup sales. You just add, then you subtract intergroup sales. Can you give me that figure? Help me with the figure, the consolidated. Who has a figure? Who has a figure? 13,540. So many people? 13,540. Good. If you don't have unasema. Then the next one is cost of sales. COS. Cost of sales. So cost of sales, the same thing. Thinking begins after you have added the 3. So this is 40/40, 40/40 plus 29/10 plus 10/20 for 6 months minus, tupatane hapo. Let's meet there. So 40, I know there is a small reflection there, but I hope you are following the paper. 40 plus 2910 plus 1020. But 1020 times 6 over 12. And now, let me present, then I'll explain to you why I've done that. Whatever you have subtracted as intergroup sale here, you also subtract it down here as cost of sales. So, but I'll tell you why I'm doing that. So again, subtract the 400, the same value, which was intergroup sales, you also subtract it down here. Then you add to it, you add to the intergroup sales, the UPI, the unrealized profit. So add unrealized profit. Don't worry, I'm going to explain at a level. So the unrealized profit was 20. It was which working, please? That was working number. There's something I need to show you there. It was working number. UPI was our working number 3. So even in exam, hapo chini ya hiyo 20, unaandika hapo W3, working 3. Also for your own reference. So that was working 3. So what I want you to do for now, just give me the figure. Where people will be having questions is y minus 400 plus 20. I'm going to explain. Never to next. For now, just give me the answer, the total. Give me that total. Who has a figure? 70, 80, 70, 80. So this is 70, 80. So before I get the gross profit, which is the difference, allow me to explain. In the next question, I'll not be explaining. What you subtract there, you subtract, then you add unrealized profit. What we are doing is this. When H, I don't know who sold to who sold the goods. During the year, S Limited sold goods to H. So it is S. Parent is here, S is here. So S sold goods to H. So in the books of S, the 400 was recorded as a sale. They recorded a sale of 400. When H received these goods in their books, they recorded a purchase. They recorded a purchase of 400 as well. So mimi nikikuzia 400, mean a record sale of 400, we're going to make a purchase here, 400. Now, in the sales, we subtracted upper revenue, the 400, because it's a sale to group member. Sale to a group member is not a sale per se. There is no sale. That's why we subtracted it here. When we come to the cost of sales, what are the direct components of cost of sales? The basic components is the opening stock plus purchases minus closing stock. So purchases is a component of cost of sales. And you see these people recorded a purchase. So it means in the cost of sales of H, the 40/40, there is the 400, which came internally. But now the issue we have, the 400 is profit inclusive. It had this profit, the one which has not been realized, this 20. There was unrealized profit of 20 in this 400. So to get cost, you take the 400, you know sales must be above cost. So take 400 minus 20. So the cost is 380. So during consolidation, you're supposed to subtract the 380 from cost of sales. But to avoid wasting time, there is no accounting crime. I'm committing when I say minus 400 plus 20. Minus 400 plus 20 is minus 380. So a student who wants to waste time, well done, 400 minus 20, upate for 380, then you come and say here minus 380. But to save on time, just say minus 400 plus the unrealized profits. When you add unrealized profit to this, you are reducing the sales to cost. It will now be minus 380. So I hope that one you have understood. So whenever there is intergroup sales, is automatic. There will be intergroup cost of sales. So whatever you subtract here, subtract it here, then add unrealized profit. Yes, banana. So the difference between revenue and cost is the gross profit. So how much is our gross profit? Gross profit 6460. 450. Proceed. Tunashikilia hiyo yao, hatutoki hapo. We are just there. Distribution cost. You go with their format. So distribution cost. Distribution cost hata ina maneno. Unless wewe uko na neno na wao, you just add 1150 plus 350 plus 340. Am I doing the correct thing? No. Distribution is 725. Check well. I think I'm writing things which are making me happy. 725 plus 200 plus 220. 220, 6/12. Give me the answer. Patia your answer. $10.35. $10.35. Please remember expenses to subtract. Kuna watu wengine wanapata answer, yeye anaweka tu hivyo. Narudisha fellowship. Make sure expenses you subtract them. Haya. Administrative. So administrative, you add 1150 plus 350 plus 340 plus. Now, I want you to listen and listen carefully. In group accounting, impairment, you are ungeandika mahali casually, impairment and amortization are classified as part of administrative expenses. Please take that into account. I repeat, in group accounting, impairment and amortization are classified in administrative. Depreciation is classified in cost of sales. In this question, there was no depreciation. We had amortization. So in group accounting, we'll be doing many of them. Depreciation is part of cost of sales. It was not there. If it was there, impairment and amortization are to be classified as administrative expenses. So there was amortization, which is an expense. It was 20. This one was working number. You know those 20, there were two of them. This one was for working 2. This 20 was for 2, yes. So this one was for working 2. So that is in amortization. So give me the consolidated. Give us the consolidated. Consolidated itakuwa ngapi? 1690. So this is 1690. Well, 340 umechukua 6/12. Nancy, 4. Oh, 6/12, this one here. So you sijaweka, nasitaki kuharibu space yangu, I'll just say divide by 2. You know 6/12 is a half. So there is no crime. I will multiply by that half. I hope you have, whoever's given me the answers, Hilda and the rest, I hope you consider 6/12. I hope you took 6/12 into consideration. Let me confirm. Yes, okay. So you subtract. That one they are calling profit from operations. So profit from operations. Profit from operations. So you take 64.50 minus all this. How much? Operations 37.35. Then we proceed. Investment income. Investment income 600. Only parent and investment income, so you credit there 600. Finance cost. Finance cost is 450 plus 175 plus 320. 320, 6/12. Give me the answer. Hakuna kitu ngumu kwa group, by the way. Group is just something which is very easy, provided you interpret it properly. Hakuna story mingi. $785. You subtract. Then now what you get is profit before tax. So profit before tax. Profit before tax is how much? $33.50. $33.50. Then income tax. Income tax, you add 680 plus 80 plus 440, 6/12. Ngapi? That is 980. So profits after tax $33.50 minus 980, 25.70. I'm just following their format. Other comprehensive income. Other comprehensive income So under other comprehensive income, I'm seeing gain on property revaluation. So gain on property revaluation. Gain on property revaluation, 70. Therefore, total comprehensive income, will be how much? I'm being requested to confirm. Caro is requesting you to confirm profit before tax. Profit before tax. So please, I hope you have not copied something which is not in order. You are the ones confirming, not me. How much should it be? Someone to confirm the profit before tax. Carlos requested, can you confirm profit before tax? People are saying it should be 3550. So if you have another intending this, 3550 minus 980. It will be minus that one. Now it should now change to. No, that one should, it remains the same. Eh? Okay. So plus 70, we will be talking of 26. 26, 40. Good, 26, 40. So I think I'm the one who wrote it. Instead of 35, I wrote 33. So I'm the one who wrote my own stuff. There. Good. Now hii kitu inafaa iishe tu hapa, lakini kuna vitu zingine unakuja hapo mbele which can interfere with your moods. But how do we mark this? 8 marks, I can assure you 100%. You only need 4 ticks. Only 4 ticks. Here. You need 4 ticks to get the 8 marks. And I know where students will get 4 ticks. Students will always get this. This one here. 1. Tax, what wanapata. Finance cost, hiyo pia mngepata. Investment income, hiyo pia watu wanapata without struggling. Even distribution. Even by the time unaenda kwa mtihani, you'll be getting revenue, I know. Because mtajua, it is only subtraction of intergroup sales. So what students will get without struggling are those ticks there. 1, 2, 3, 4, 5, 6. They only need any 4. Any 4, ushapita. But now it is not complete. There's something coming up below this, which is just a waste of time. I wish I was not even to show you not to worry. But now I have to comply with the standards, what the standards requires. Now, in group accounting, okay, swali already tushapita. Hata tuko kwa watu wa wada, hapa tuko kwa ligi ya watu wanahesabiwa apati ya wada ama mwingine. So ushapita. But now to comply with what the standard requires, we have to complete it thoroughly. Once you get the profits for the year, not this comprehensive, the profits after tax, this 2570, it must be shared. You must share it between the parent and the minority. So you have to show us the profit share. So you'll come down here and say, profit, PAT, just call it PAT, that is profit after tax. Let me try to check the camera. Yes. Profit after tax attributable to profit after tax attributable to noisemakers and holding company. So we will share to them. We'll share to them the profit. Then bottom single line there. So the profit we are going to share to these two is this 2570, the PAT. So the total will be 2570. Then total comprehensive as well. So total comprehensive. Total comprehensive to also noisemakers and holding company. Like that. So it ends there. The total comprehensive is 2640. Perfect. So have that. Then now we see how we are going to share. People are done. So now we want to share this profit of 2570 to these two, minority and holding. So how do we share the profits? Another minority. Minority are only the books of the subsidiary. Wow, subsidiary, parent. But you see this consolidated profit of 2570, it has been brought by parent, subsidiary, subsidiary, parent, subsidiary, subsidiary. So there is part of 2570 which was brought by parent alone. So if you just take the percentage, NCI at this times that you will be lying to the parents. So what you do, you must determine how much profit of the subsidiary goes to the minority. So minority in the group only takes the profit of the subsidiary. Take that into account. NCI are only entitled to the profit of the subsidiary, not profit for the group, for the subsidiary. So have a working, call it working for. Call it working for. You say NCI's PAT share. NCI's PAT share. Profit after tax share. So we have two NCIs here. We have NCIs in S limited and we have NCI in L. So we need to get the two. So the PAT, can you check PAT of these two entities, S and L, in the P&L, in their P&L? So in the P&L, the one which we were provided with, profit for the year of course after tax, this one was 165, if you can read with me. 165. This other one was 860, but for 6 months. So you will take for 30. I have 860 times 6/12. Please show it upper bracket, I don't have space in brackets. 860 times 6/12. You see that put it for 30. So 860 by 6/12, that is for 30. Then there are some items affecting the profit of S. One, in the books of S, there was amortization of 20. There was unrealized profits. S waliuza hizo goods. If you check that note number 4, S is the one who sold. This is called upstream. S sold the goods, so their profit is affected. Also, in note 1, the brand, that brand which we are being told The brand was in the books of S. So that amortization must affect. So you will less amortization 20. You will less UPI and realized profit 20. This other side, there is nothing to adjust. So the adjusted is what we are going to share. So this one will be 125. 125, really? Yes. Then this one remains for 30. For 30. Therefore, NCI will take in S. Remember, parent acquired 80%. Parent acquired 80% of S, meaning minority will get 20%. So we'll take 20% of 125. Then the other side, minority will take 50. Upper minority and parent were the same. They are the same. The only difference is that now parent is the key decision maker, appoint majority of the board. So NCI will also get 50. So give me 20% of this, then 50% of that. Give me those two answers. Kindly. The two answers will be 25 to 15. 25 to 15. Total to 40. Total to 40. So in this group, the profit which goes to the minority after tax is 240. So minority takes the profit after tax of the subsidiary, not for the group. Group gani na wao wakupa subsidiary. So NCI, PAT attributable to NCI, you come here, you talk of 240. So to the parent, you will take 2570 minus 240. What remains? So you take 2570 minus 240. What do you get? 2570 minus 240, you get 2330. So this is 2330. That is gone. That is gone. Good. I hope that is done. All right. Now let's go to total comprehensive. Here. How did you get the total comprehensive? Here. You took PAT plus revaluation. So now the same here, you will take what someone got in the PAT. So PAT, they have gotten 240. PAT, they have gotten 240. Revaluation, they are going to get 0. Why 0? I'm not going to give them anything for the revaluation. Why? Why am I not giving them anything? Who can guess? Revaluation, I'm not giving them anything. For what reasons? The reason as to why, as you keep on thinking about it, the reason why we can't give them revaluation, if you check the question, this 70, the 70 is in the books of the parent. Minority are not entitled to take their legs over parent. They only take their share in the subsidiary. So if the revaluation was in the books of subsidiary, perfect, ningewapea percentage yao. But this 70 is in the books of the parent. What is in the parent is for parents. Huh? Your parent, your parent. Your group, your wanna share. So minority will not get revaluation in the books of the parents. Meaning, of the total comprehensive of 2640, parents will take 2640 minus 240. So parent will go the 2400. We have successfully done that question. So this one, NCI, this is working for. But now you see hiyo kitu itakuestia time kwa mtihani. Vizuri sana. Hiyo ya profit share is a complete waste of time. But now you see I have to comply. But we fika hapa, you just here. Ushapita hiyo mtihani by far. What the examiner wanted, uchapata. They wanted two things. The deep one was you seeing L as qualified to be a subsidiary. Najua watu wakishaona 50 wanasema hiyo wacha. We don't have control. We are not supposed to consolidate. So the first identification was knowing that L is a subsidiary. Then number two was the apportionment of 6/12. So once the student knew L is to be considered as a subsidiary and also we consider 6/12, well, Shapita, the things which can make a student pass that question utapata. Hizo zingine wewe wachana nazo. Utakuja kufanya for fun baadaye. Somebody to ask me a question. If there is no question, I'm giving you 3 minutes break. Then we go to the balance sheets. So during the 3 minutes, which is 7:10, let's meet back at 7:15. Mtu stretch kidogo, ukunywe maji, uangalie dirisha kama hapa kuna nyesha kidogo. You check, then we come back 7:15. We proceed with our balance sheets. Break is over. Break is over. So we proceed to the balance sheet. Where's my pen? So allow me to delete this. Balance sheet, get this. Balance sheet mostly inakwanga kama ni 12 marks. Sometimes they just need the 12 ticks. But kama wanafunzi wanaanguka, this one it would be 6 times 2. So you can have 6 correct or above 6. Kwa hiyo uko sawa. Ukiona unapata 6 na zingine ni ngumu kabisa, ujue ni ngumu kwa kila mtu. So itakuwa 6 times 2. Lakini ukiona umepata kitu kama 9 uko sure, then most likely itakuwa 12 times 1. So unajipanga. So start writing the heading, H group. For one column, shillings are in millions. I don't think if I need this light. So the way we did that other one, let's come to the balance sheet down there. So we just move with it. So non-current assets, property, plant, and equipment. So that is PPE. Balance sheet, we said there is no apportionment. There is no apportionment regardless of the date of acquisition. There is no need of, you can't apportion assets. It's not self-same. So you come here, you add 4,600 plus 4,940 plus 3,820. The only thing you need to check on the assets during consolidation is the concept of revaluation, depreciation, and the rest. They were not here. Which one? Give me the answer. Your face is fine. What do you get? $13,360. $13,360. To proceed, investments. Investment in S and L, you don't bring them. You don't bring them during consolidation, please. Those are intercompany investment. So investment in subsidiaries, you replace it with goodwill. Actually, we adjusted them to goodwill. So give me the goodwill. Goodwill. I think this was our working one. So check working one. There were two of them. There was this and that. What plus what? There were two goodwills there. We did them in working one. What figure and what figure? $360 and $340. So $360 plus $340. All of them were in working one. $360, $340, that should be $700. So investment in subsidiaries, you don't take them to consolidation. Those are intergroup investment. You bring goodwill. Before I go to this equity investment, there was a brand. You remember there was a brand. So brand, we got 100. That should be working two. We got 100. Then there was annual amortization from that year of acquisition of 20. But now, the problem I have, check note one. You know, that subsidiary was acquired on 1st November 2019. We are preparing books in 2020. Amortization was annual. So you see for P&L, you just recognize 20. But balance sheet, you subtract the accumulated amortization. So 2019, 2020, 1, 2, 3 years gone. Balance sheet, you subtract the accumulated. We started amortization in 2019. But for P&L, the one we did every year, you know P&L is year-based. So you just subtract 20, 20, 20. But for balance sheet, you subtract the accumulated. So you will take 20 times 3 years. This was working 2. So 120 times 3 is 60. So we are reporting brand 40. Then there is equity investments. Equity investments. This one is 4,000. Then there is nothing. Can you add for me the total of the non-current assets? Thank you. 18,100. 18,100. Then we go to current assets. I hope I'm not too fast. No, hii mambo ya ndani inakuanga na maneno mingi. Tell me, begin protection 5. Are you people going to do the MA? Let me know, please. Because kuna hiyo mambo ya CASNET. Are you going to do MA, advanced MA? Ama nini see part of the people who are going to do MA? Are you also who qualifies then for MA? Where I say no. Who is going to qualify for that thing? Who are the people to sit for advanced MA? I never even got time to read it. So who are the people who are going to do it then? You know, MA is coming back in January next year. I hope you are aware. Vera, whoever will register in January for section 5. Whoever will register in January for section 5. So those are people who right now are in section 4. Yes, will register for April section. So it means those who are in section 4. I wonder about it. You know, MA is very difficult. I don't know, it depends on people, but me, I get MA to have a lot of issues. So you know, immediately when I get MA to be a selective paper, selective or elective, whichever it is. Since then, CASNEP has never recorded more than 30 students in that paper. In Nawanga, around 18, 20, 22, people ran away from that paper. So they said, okay, we are bringing it back. So it's good. It is very dangerous, even compared to a farm. Is, you know, a farm, provided you know the formats, you are good to go. But with a mail, utapewa swali, alafu I'm going to advise the company. You don't know you're advising from east, west. So, nyinyi mumaliza mkiendana. Haya, current assets. Current assets. We have inventory. So inventory. Inventory, this is 2250 plus 2450 plus 1875. 1875. Then you subtract UPI. In any group question, subtract the unrealized profit on inventory. We don't recognize stock at profit. So the UPI is the 20. I think it was what in 3. Make sure you subtract. So that is the UPI. So can you give me the answer? Add, then you subtract. Mercy, 65, 55. Then we have receivables. Receivables, you will take 1980 plus 1710 plus 2700. So then what you need to subtract, students, is intergroup debts. Kama huyu alikuwa na deni ya huyu, we subtract. But in this question, hakukuwa na anything of that nature. There is nothing. So there is nothing to subtract. Otherwise, receivables will normally subtract intergroup debts. Give me that answer. Maisha imekuwa nywe sasa. 6390, fancy there. 6390. Then we have cash and cash equivalents. We are like a cash, whatever story name. So cash 870, 600, 705 plus CIT. CIT stands for what in full? What is CIT? CIT stands for what? Yes, cash in transit, which was not in this question. Just in case it was there, you would have added it here. And by extension, you subtract it from receivables. So CIT was absent, but if it was there, you could have added. I'll give me the full. Mercy 2175. And therefore, total assets. Total assets. Total assets will be how much? The total assets from 18100. Mercy 33 to 20. 33 220. I know tukienda huku chini, there are two things which are going to make our life very difficult. Retained earnings and non-controlling interest. Those workings usifanye kwa mtihani, I've told you. They will waste your time, you might end up not getting them. Already ulikuwa ushapita na hizi zingine. You hata hapa kama examiner alikuwa anataka 6 months. I can tell you where you will get the 6. I know. By the time unaenda kwa mtihani, UPI kila mtu hapa atakuwa anajua kufanya. So all these currents hizi mungepata. Those are 3, 4, 5. Already labda uko na 10 na unataka kufanya workings and defy. So for here we have to. So before I go to, so right there, equity. Equity and liabilities. So before I start equity, you will allow me to do those 2 workings because I will not move. But in exam, there is no need. So we need to do a working for the retained earnings, group retained earnings, and the non-controlling interest equity. You must tell minority their equity in the group. So have working 5 outside somewhere. If you work up, if you combine, leave a good space, then do the working scandal. So working 5, retained earnings, group retained earnings. Group retained earnings. So retained earnings. Which way should I take? Let me just think on how to the best approach to give it. Can give it that approach. So you can say here for H limited. Remember, we are in the balance sheet. So check the retained earnings in the balance sheet kindly. Check the retained earnings in the balance sheet. Check the retained earnings in the balance sheet. For retained earnings in the balance sheet, for H, you are seeing 34.20. Then you add what we call post-acquisition profits. The profits these subsidiaries generated after we acquired them. So you add post-acquisition profits. Post-acquisition profits, 1 of S limited. S limited. So for S limited, post-acquisition profit, the parent company will take 80%. 80% in brackets. What is post? Post means the profits they made after acquisition. Remember, S was acquired in 2019. We are in 2022. So the profits they made in this period from acquisition up to here. So right now in the balance sheet, they are reporting 2070. Check whether you are seeing 2070. Check whether you are seeing 2070. Yes, you can see it. So 2070 is the profit today. Post, subtract the profit which was there when we acquired S. Check additional information number 1. Tell me how much. I just want to check whether we are together. How much was the retained earnings of S on the date of acquisition? Who is able to see it? It could happen not one. 340, yes. Their profit on the date of acquisition was 340. So post-acquisition is what they made between 340 to 2070. So minus 340. So that is the profit they made after acquisition, but there were some expenses. There was unrealized profit, there was amortization, those two. So you have to subtract. So this was working 2, working 3. So you subtract, then you share. That is the post-acquisition profit. So this is the closing. This was profit on acquisition. These are the expenses which came after. Give me the 80%. Kindly. So can you give me that 80%? The one which tutakuwa tumekosea ni hapa. Hii ya working number 2. The amortization should be this one here. 20 times 3 years. Because from 2019 it was losing 20. So here you will take 60. The accumulated amortization. Yeah, you take the accumulated amortization because it is 20 from 2019, 2020 for 3 years. So you subtract 60. Please indicate in your books 60 is accumulated amortization for 3 years, so that you don't confuse. Meanwhile, Mercy, you are giving me 1320. 1320. I hope that is okay. Can one person also confirm? 1320, 80%. Mercy, I hope you have multiplied by 80. Yeah, that will confirm the 1320. Then for L Limited, L has an issue. L 50%. 50% for the whole year. I remember they made 860, but for 6 months. You know, EL required. They made 860 here, the whole year, but they were acquired here. So post-acquisition, we are only concentrating from here to here. Only from this space here to here, the 430. So the 430 is what we multiply by 50%. So that one has no problem. It was coming to 2 something. It was coming to 2, we did it somewhere, 215. Full stop. So that is the consolidated retained earnings. Can you add everything? That is the consolidated retained earnings. Add for me everything. What will you get? 49.55. Correct. Only one working remaining for NCI. Once you have NCI, your balance sheet tunamaliza. So I don't know that I can squeeze it here. Call it working 6. NCI's equity. If you don't tell them their equity, they will bring problems. So you will get in S and in L. In S and L. Once we have that, so how do you get the capital of minority? You start by saying, what was their market value on the date of acquisition? So check working 1, where we calculated goodwill. What was the fair value at acquisition? So when you have an acquisition, you will top them up with the profit which came thereafter. This one's here. So in S, parents took 80%. Minority, I'm going to give them 20% of this figure. In L, it will be the same 50, it was 50-50, so it will be 215. So you just say fair value on acquisition. Fair value on acquisition. Give me those two figures. Mkonazo pale for goodwill computation. I remember there was 970 and the other one was the one we calculated. Give me those two answers. 970, then 1500. 970, 1500. So the date we went for acquisition pack, this is what they had. They could walk around telling people we have investment now at 970 and 15. As time goes by, the profits made by that company, you top them up. You keep on topping them up. So add post acquisition profits. Post acquisition profits. Add post acquisition profits. So post acquisition profits in S, I'll give them 20% times. Please, what was this figure coming to? You will show where it's coming. 2070 minus 340 minus 60 minus 20, because showing it here again. Me, because of space, let me not tell you because of my space. You can show. You say 20 in the brackets, 2070 minus 340 minus 60 minus 20. What was it coming to? No, 1320 masses after you multiply by 80. Just this bracket alone, which I want you to show. I want you to show 20 in brackets. You subtract all this. Is that 1650? So you multiply by the 1650. But in your bracket, make sure you show me this so that we are good. So give me 20% of this 1650. That is what that company made after acquisition. So what is 20% of 1650? $330. Then L hawana maneno mingi. 50% times 860 times 6/12. This one has been 215. So add this, add that. Give me the two answers. Give me the two. 970 plus 330, 00. It is 13. Then the other one, 1715. Right, you need to answers. So that after that, sasa ni kusonga tu pole pole. Mali. 13, 17, 15. 13, 17, 15. Thank you. Let's go back to presentation. Let's go back to presentation. Unless someone has a question. Unless someone has a question. There being no question, we go back to presentation. Ordinary share capital. So tunaenda back to how they are presented. So ordinary share capital. What figure can you give me there? I'll be very happy to see a figure. What do you think ordinary should be? What should be the figure for ordinary? Ordinary. Maculate, 3,000. Yeah, that is correct. In group accounting, and listen to this and listen carefully, we only take for parents. Hizo zingine tumeshare huku mpaka imeisha. The parents took their share when calculating goodwill, minority also take their part. So in group, ordinary, we only consider for parent. Where else is where you have to parent only. case baadaye. So that is why Immaculate is saying 3,000. Parents only. 3. You're not free check for those who will be in the exam room. Then we have share premium. Even share premium the same, parents only. Let's go back to parents. 2,000. Just imagine how easy things have become. Revaluation surplus. Revaluation surplus for 80. Our retained earnings 49.55. So I'm deleting. So bring retained earnings. There. So retained earnings. Working 5. 49.55. Then sister yao non-controlling interest. Non-controlling interest. Working 6. Working 6. Can you add for me this 2? Can you add the 2? 1,300 plus 1,715. That is working 2. What will it be? $30.15. Correct? Then there is nothing for equity. Can you add for me the equity alone? Mercy, 13,450. 13,450. Then we go to non-current liabilities. Non-current liabilities, there is long-term borrowings. So borrowings, you just add 44 plus 25. 44 plus 25. How again, that one is 69. Yeah, that is 69. Deferred tax, so D tax. Deferred tax is 1240 plus 920 plus 1750. What do you get? When you add deferred tax, what will you get? $39.10. Current liabilities. We have payables payables 2240 plus 1570 plus 23. Tell me what you will get when you add. When you add payables, what do you get? 6110. Current tax 1250 plus 640 plus 960. What do you get? $28.50. Therefore, total equity and liabilities. Can you confirm whether it will balance with our total assets? Our total assets was 33 to 20. So can you add 13,450 plus all that, whether it will be in agreement? Whether it will be in agreement. Agreement means whether it is balancing. Mwende? Yes, balanced. So balanced is 33 to 20. 33 to 20. So let's check possible marks here. Possible marks. Ama nyinyi mniambie. Can you list mkisema na mark the one you are sure beyond no doubt? You list them, then I mark. Which ones? I want to see what you can get without struggling. Which ones? You know what you could have gotten, you as you. So can you highlight them there as I mark? Mercy, ordinary and share premium. I have wingine. Yeah, this one, of course, you will get. Another one. Those ones I know you will get without problems. Yabuti, Caro, Elizabeth, Hilda, mwezi sema tini mutapata yenye Mungu atasema. Immaculate. Nyamosi, what can you get? Kelvin. Massive, huwezi toka hivyo. Linda, mwezi toka bure. Nancy, Mwende, huwezi toka bure. Pato, Trufosa, Vera, huwezi kuwa ati wewe utapata nothing. You must get, Eliza, you must get something. So, Vera, cash, receivable, borrowings. Kwa nini mwenda hapo kwa borrowings? Deferred, current, cash. So, yeah, I know what you will get without problems in this question. Here you will get this, you will get that. Inventory mko na sahau kidogo kwa mwenye mtakuwa mnaenda mtihani ndio mtapata. So you will get this, you will get that one. You will get this, you will get this, you will get this, you will get that. Hiyo zingine unaweza achia Mungu. So if you can get 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Even on the worst case scenario, on the extreme end, waseme ni 12 at 1. It means here you can get 10 over 12. Na ile ingine tuliona 4 ilikuwa inaingiana without problem. So the other time 4 times 2 was 8. Sasa wewe ukipata 18 over 20 kwa group accounting, unafikiria you are just ulishapita hiyo mtihani by far. So it's very easy. The things which waste our time ni vitu zingine hapo small. Haya, meanwhile, let that one stop there. Right for me there. So I want to unmute you. I want someone to talk with courage. What do you think was the main aim of this question? I want to unmute. Somebody can just, these are democratic class. Please, you can unmute and tell me, what do you think the question was highly focusing on? You know, we are not interested in this computation where people are balancing a are you getting the base? What is the examiner really focusing on? So what was the main thing which, if you understand, you are good to go? Someone to unmute and tell us, or I'll appoint. Someone can volunteer. Kama jina yako inaanza na A, ujue uko kwa shida. Yule uko hapo juu. Aya, Vera. Vera, what do you think was the main issue with the question? You can unmute. Let's just make class interactive. Tusikwe serious, hapana. Just no more. What do you think the question is really focusing about? Before we go to the next issue. No, I've enabled you to unmute. Okay. Oh, sorry. Yes, I have now. Yes, Mercy, because you are the one who was saying, can you say if...
Mwalimu, the examiner wanted us to understand that L Limited is a subsidiary because of the 60% right of right to appoint 60% of the board of, yeah.
That was the most critical part. Actually, that was the most critical part. And that is the first and very time Kasne brought such kind of question. Since I have all the past papers from 1999, when some of you here at our Mezaliwa, let me not mention, but in all those questions, there is none with such kind of concept. So in fact, last sitting, I was afraid they were going to bring that concept, but I've just checked right now, they did not. So this concept can bounce back. It can bounce back anytime. It prepare students rough time. Because, you know, if it is 50%, that's a joint venture. We don't consolidate for joint ventures. We don't. So here, we only consolidated for the joint ventures because of the right to appoint majority of the board members. So kindly, wakileta kitu kama hiyo, hata kama ni 40%, but they have the right to appoint majority, unapita nayo. So it will be an exemptional case. Parent will be having 40, minority 60. So minority in terms of shareholding, they have more, but in terms of control, parents they wanna dictate what to do. So that was the main concept, and that's why I've done that question. So, right for me there, piecemeal subtopic. It is 801. Class itaisha by 8. By 9 sharp. Kwenye 9 tafika, we'll stop there. Piecemeal. Stock. Step. Step. Acquisition. Piecemeal stock. Step. Acquisition. So, piecemeal stock step acquisition, I've seen it being examined 2 consecutive sittings. It was examined in April and it was examined again in August. So predictors, what other predictors, ilileta watu off because nobody, including teachers, hakuna mtu alikuwa na expect piecemeal to come back. So to that effect, it can still come. So we have to be okay. Sisi tunaangalia kila kitu. So I would request you to go to the handout. Naona watu wengine wameanza kutoka class. Mkitoka hata mimi mtafanya sasa nitoka. So tukae hapa. Tumulikuwa mmepanga 3 hours. So back to our handouts. Handouts, let's meet in page, which page, students? Let's meet in page 7. Let's meet in page 7 of the handouts. Let us meet in page 7. Let's meet in page 7. And Mercy and the rest, it is not a matter of appointing majority of the board only. There are 4 conditions. 4. So wewe usishikange tu majority of the board, alafu waende walete any of those 3, alafu ushindwe kuona. So I would like to revise that again. Go to page 1 before I come to page 7. Let's go to page 1. We see when it qualifies to be a subsidiary of the handouts. Handouts, let's go to page 1. Let's go to page 1. So in page 1, in the key terminologies, number 2, under identification of subsidiaries, control is presumed when the parent acquires more than a half of the voting rights of the entity. Even when more than 1/2 of the voting right is not acquired, control may be evidenced by power, number 1, over more than 1/2 of the voting rights by virtue of an agreement with other investors. So if they agree that parent will be having more voting rights, they want extra. You can examine, I can just tell you, parent was to cast 1 extra vote during AGM or something, then that one also qualifies that company to be a subsidiary, regardless of the percentage. So if the parent has more voting rights than that other company, then that other company becomes a subsidiary, even if we don't have control. Control is 51. So even if we have less than 51, but we are casting more extra votes, then that company qualifies. Number 2, to govern the financial and operating policies of the entity under statute or agreement. So like this one, there was something like that. They were appointing a manager, the manager was to control. So if they are governing the operating policies and financial policies of that other company, then that one also qualifies them to consolidate for that company. To appoint or remove the majority of members of the board, that one was what we have done. To cast the majority of votes at a meeting of the board of directors. Unajua kuna ile voting ya AGM na pia kuna voting ya board. So number 1 and number last are more or less the same. So casting more votes, making decisions, removing or appointing majority of the boards. In a position where any of those 3 exist, then that company is a subsidiary, regardless of the percentage. So let's go to page 7. 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 Page 7, step acquisition. Step acquisition. This takes place when the parent company obtains additional shareholdings in the investee company. Correct. So check here. Check here. Check here. Let's say this is January. This is December. January, December. Correct. So from the start, so this is 1st June. This is 1st June. So from the start, the parent was having 40%. 40%. From the start, parent was having 60%. Then on this date, they sat down with this company that we want to add you money. We want to add you money so that we acquire more shareholdings. So they topped up 20%. So when they add 20%, so plus 20%, here now, from this date onwards, it will be 60. On this date onwards, it will be 80. This is what we are calling step acquisition or piecemeal, topping up shareholdings as time moves by. So the question will be, how do you consolidate? Because they are adding shareholdings during the financial period. Allow me to start with the second scenario. In the second scenario, there will be absolutely no change in consolidation, because before the top-up, it was a subsidiary. After the top-up, it is still a subsidiary. So the only element which will change, is NCI. NCI, when you are giving them profit, you will give them profit of 40%. Here, this one here. For how many months? You will give them 40 because parents are in 60, so minority 40. 40% for how many months? 40% for how many months? How many months are those? Those 6. And nilikuwa nataka kuwashikia hapa. Those can't be 6 months. 5. Those are 5. Those are 5 months. January to 1st June. This is 1st June. 1st June. So these are 5 months. So you will give them for 5 months, then 20%. 20% for 7 months, like that. So only NCI will be affected. But during consolidation, there will be absolutely no change. That is what you need to know in step acquisition. There is no change in consolidation. For income and expenses, you will add in full without any interference. The problem will come on this one here. For this one here, 40% is an associate. Associates, you are not allowed to consolidate for them unless otherwise. Mnajua ni gani. So associates, we don't consolidate for them. You only consolidate for the period it is a subsidiary. So in the P&L, you will take parent in full, then subsidiary, you will take subsidiary for 7 months. So income and expenses of the subsidiary, you will apportion for 7/12, this period. So you apportion the P&L. Then balance sheet, you will take parent and subsidiary in full. We don't apportion balance sheet regardless of the date when it became a subsidiary. So what happens, you find that it was an associate, then they topped up to be a subsidiary. So P&L, you only consolidate when it has qualified to be a subsidiary. Balance sheet, you take in full. So there is no, hakuna kitu kubwa. It is, so step acquisition or piecemeal is just a scenario whereby the parent is adding shareholdings as time goes by. Back to our notes. Step acquisition. We are in page 7. This takes place when the parent company obtains additional shareholdings in the investee company. For consolidation purposes, the parents need to account for its interest at the end of the reporting period. If the additional shareholdings qualifies associate or joint venture to become a subsidiary, then the income statement will be apportioned for the period when the investee became a subsidiary, while the consolidated statement of financial position should not be apportioned, provided that the investee became a subsidiary at the end of the reporting period. Goodwill is computed based on the net assets at the date when the investee became a subsidiary. So when calculating goodwill, you will calculate goodwill when it qualifies to be a subsidiary, not on the date when it was acquired as associate. So on the date it became a subsidiary. Illustration, August 2023, that is last sitting. August 2023. August 2023, question 1. So ungeandika kwa kitabu the step acquisition so that you will know. Ile tulifanya inaitwa tu normal. That is normal accounting, group accounting. Now this is step. So August 2023, question 1, page 1. Be there. Where the 9 a.m. will get us, that is where we are going to stop. So let me not become a dictator. Let me hear your views. Are you of my opinion? Where 9 gets us, we stop there, or we stop right now? Let me not become super dictator. What do you think? We move up to 9. So no. Where 9 gets us, sour. So where 9 gets us, we shall stop there. Where 9 gets us, that is where we shall stop. Thank you. Thank you for also showing interest. So I want us to read that question. Remember, we are again meeting at 6 p.m. Johnny. I'm going to share with you just immediately after class my plan on how to finish the remaining topics. So I'm going to share. Group is going up to when, this is going up to when, and the dates, so that we can prepare accordingly. Which class do you normally have on Tuesday and Wednesday, early morning? Allow me to know, which classes do you normally have on Tuesday and Wednesday? Tuesday and Wednesday, yes, early morning. Tuesday and Wednesday. Tuesday and Wednesday, yes. So Tuesday, LM, Tuesday, LM, then Wednesday, FM, LM, FM. So now I'm gonna mwalimu because I don't know, I'm not sure, but tuko na AGM ya ISPAC, the annual general meeting ya ISPAC, on 20th to 24th. So I checked 20th to 24th is Monday to Friday, November. This is November. So it will affect our class on Thursday. It is affecting our Thursday class. So I I will check mwalimu gani anaweza nikanyagia siku moja, because I'm free on Tuesday and Wednesday. So I'll see mwalimu gani anaweza niachia siku moja. I teach that class. Then ikikuja hiyo Thursday ya hiyo siku, can take up that class. That is the only day I suspect. I'm not confirmed because I'm not even paid. It's a lot of money. It's fun. It's a lot of money to attend those things. So I'll determine whether to attend or not. So it will not affect anything anyway. All right, so allow me to read the question. H Limited, a public limited entity, had exercised significant influence over S Limited. Nyabuchi, significant influence exists at what percentage to what percentage? They have said they exercise significant influence. So significant influence exists between what percentages? Carol? Lisa? Hilda? At least those four, one can answer very fast. Carol? 20 to 49. Yes. So significant influence exists between 20 to 49% associates. Yes, 20 to 49. So S Limited, a public limited entity, had exercised significant influence over S Limited. That one means S was associated by them, another public limited entity, for many years before obtaining control. H Limited acquired a 40% ordinary shareholdings in S on 1st April 2013 for a cash consideration of 2,500 million. When the retained earnings of S stood at 360. So the draft statement of financial position for the two companies as at 31st March 2023 are presented below. So we have their balance sheet as our eyes is capable of seeing. Let's go to the notes. Note number 1, H Limited acquired a further 30% interest in S on 1st April 2019 for a cash amount of 2,200 million this date. So e-balance sheet milling. Now what are they talking about? You know, this balance sheet is 2023, and they are saying they are topped up on 1st April 2019. So 2019, even they topped up before this year. So 30 plus 40 is 70. So it even became a subsidiary. Why are they joking with our mind? It became a subsidiary even before this year. Even before this year. So it means when the year started, subsidiary. So even there will be no any problem to that effect. Okay. The retained earnings of S Limited amounted to 860, and the fair value of the previously interest of 40% interest in S was 3,000 million. Okay. At the time of achieving the controlling interest in S Limited, the fair value of its identifiable net assets approximated their carrying amount with exemption of the following items. 1, an item of plant whose fair value exceeded its carrying amount by 150 million revaluation. On 1st April 2019, item of plant had a remaining economic useful life of 6 years, depreciation. On 1st April 2019, the directors of H identified that S Limited had internally generated database. My paper is not very clear at that end, but I hope that is database for customers who have the potential of purchasing their product for an indefinite period of time. I don't know what. There were no contractual or legal rights associated with the database. A professional expert estimated that a competitor of S Limited will be prepared. Okay. What estimated? Expert estimated that a competitor of S Limited would be prepared to pay 90 million for this database. S Limited had recognized the database as an asset in its individual financial statement, no problem. I have to check, I have to go to Ile Mlituma kwa simu. That one is quite fair. I'm getting things which is not right. It's not best practice to do that. So allow me to open in the group. So let's go to note number 3. Note number 3 says, the group's policy is to measure the non-controlling interest and their proportionate share of net assets in the subsidiary at the date of acquisition. On 28, H Limited sold goods worth 100 million to S. H Limited reported a gross profit margin of 20% on this sale. S Limited had neither received nor recorded these goods in the books of accounts, goods in transit. The current accounts between H Limited and S Limited did not agree due to the goods that remained in transit as per the note 4 above. As of 31st March 2023, the trade receivables of H included 600 due from S Limited, no problem. An impairment review carried out on 31st March 2023 revealed that neither goodwill arising on acquisition nor intangible assets with indefinite useful life had been impaired. So there is no impairment. Ignore all deferred tax consequences on acquisition after Turkey. S Limited has not issued any ordinary shares since the date of acquisition. Because EO number 7, number 6, 7, and 8, did they have to bring them? Because all of them are useless. So imagine sometimes unajua sawa inakushtua kwe. So so many additional information. I think it's just to scare you, because number 6, nothing, we are going to we will not use it anywhere. Number 7, no, 8, nothing. 8, nothing. So instead ya kuweka 5, ndio washtua wanafunzi wanaweka zikiwa mingi and they are useless. Required. Determine the equity accounted value of investment in S Limited as at 31st March 2019. 2019 is when they topped up the shareholdings. Then B, calculate the value of goodwill arising on acquisition of S Limited as at 1st April 2019, that is after the top up. Then consolidated statement of financial position as at 31st March. So right for me, let's start by saying equity, that is A. They want us to calculate equity, accounted value of investments. In S Limited. So have that. Najua leo watu wa Arsenal hawakulala, wale wameamka mapema kukuja class. What do we tell them? Congratulations, ama? Lakini si hata last time walifika hapo juu lakini ikaharibika. Anyway, wasiniongelea vibaya, that is just by the way. Now, I don't want to fix figures into your head. The first thing we need to check, what is equity accounted value of investment? We mentioned it in our notes, in the handout. under the equity method. Under the equity method of accounting for associate and joint arrangements. Go to page 6 of the handout so that we don't just write things which are not in agreement. Go to page 6 of the handout. So in page 6, there was accounting treatment for associates and joint arrangements. So they are accounted for using equity method. Equity method is a method of accounting whereby the investment is initially recognized at cost and adjusted with any post-acquisition reserves in the investee company. So as far as I want to start fixing figures here, please let's write something small. You say equity accounted value, equity accounted value, equity accounted value, equity accounted value is a method of accounting. Is a method of accounting whereby the investment is initially recognized at cost. Initially recognized at cost. Initially recognized at cost and adjusted. Initially recognized at cost and adjusted thereafter. Adjusted thereafter for the post-acquisition changes in the investors, post-acquisition changes in the investors with apostrophe, in the investors share of the investees, investees in bracket associates stroke joint ventures, investees in bracket associates stroke joint ventures, close the bracket, net assets. Investees net assets. Correct. Correct. So students, any moment the examiner is telling you to account for, they are saying the required, determine the equity accounted value of investment. Equity accounted value of investment, you can only apply it to associate or joint venture. So this company S, initially, it was an associate. Initially, it was an associate from how it has been framed. It was an associate where we had 40% before the top up of 30%. So when they say equity accounted investment, it means you calculate the value of investment when it was as associate, because it was 40%. So you account for it when it was associate by that time. That is what they are telling you. Hakuna story ingine hapo. Yeah, there is no other story. So it is very simple, very simple, very simple. 2 marks, 2 marks. So you come here and say shillings are in millions. Shillings are in millions. So I have two ways of approaching it. So you start by saying fair value. You will take the fair value or the original cost of investment, whatever the fair value. Original cost of investment, original cost of investment in associates. In associates. Original cost of investment in associates. So I want to move with you people. Check the first paragraph, note one, the very first paragraph where the question started. I want you to read it. That original cost of investment in associate, when it was 40%, you will see it there. I want you to give me that figure. Can you cross-check, please? Cross-check in the very first paragraph. Then you tell me how much, because I'm seeing it there. Correct. You see the way you are good people. 2,500. Yes. So initially, when it was associate, the 40%, they invested 2,500. This 2,500, you can pick it straight like that, or a student will do this. Check the balance sheet. Check the balance sheet in 2023. Check the balance sheet in 2023. Balance sheet in 2023, you can see investment in S. Investment in S right now in 2023, 47. Hold it. Then go to additional information number 1. They are saying H Limited acquired a further 30% interest in S on 1st April 2019 for a cash amount of 2,200 million. On this date. On this date, the retained earnings of S Limited amounted to 860, and the fair value of the previously recognized 40% interest in S was 3,000. So they are saying that this investment, the 25, is now 3, but total they are giving us how much? They are giving us 47 initially. That one will take me a long route, which cannot even work for me. Wachana hiyo kabisa. Forget about it. Forget about it. So the initial investment, I wanted to check if that will work. Here is to say, yeah. The initial investment is the one you are giving me there, the 2,500. Then you add, now you adjust with post-acquisition net assets. Post-acquisition net assets of S Limited. Post-acquisition net assets. Yeah. Post-acquisition net assets. So students, what are net assets? Net assets is ordinary share capital, retained earnings, share premium, and revaluation. So now, when you check this question keenly, check the balance sheet under equity. Check the balance sheet under equity. There was ordinary share capital of 5,000. Retained earnings, you are seeing 1,660. That is in the balance sheet. So it only communicates to you that the net assets are only 2. The retained earnings and ordinary. And when you check the entire question, those notes which you were saying were irrelevant, they even told us that there was no issue of shares. So it means shares, but the shares don't change. Utapata hapo siya memorandum inabaki tu constant unless the change of directors or something. So the shares are constant. So what keeps on changing is the profit. Profit deals. Profit brought down current forward evil. But shares, itabaki evil. So what you need to check, as far as the net assets are concerned, you only need to check the retained profits. That is what keeps on changing. If you are having share premium also remains the same. What changes is revaluation and retained profit. Share premium, you will just find premium and ordinary, they are constant throughout, unless there's changes which takes place, which is very rare. So in this question, there was no issue of any other shares, meaning that what we need to check for the change is the retained profits, which we check. So we'll check on the date of acquisition, how much was the profits? And by 2019, when they were topping up, because they have said on up to 2019, they have said up to 2019, that is when they want us to calculate. So we'll check up to 2019. The subsidiary was acquired, the associate was in 2013. Then they came all the way to 2019 before the top up. So I want you to check what was the retained earning in 2013 and what is the retained earnings in 2019 when they are topping up. So I want to throw the balls to you again. Check paragraph 1 where the question started. Check for me the retained earnings. Come to the additional information number 1. Check the retained earnings. Then, tell me those two figures. You tell me 300 and 400. Mwende atashasema. Unajua mwende ukiona mwende ameanza kupeana figures, nataka tumalize hii kitu mapema. Matime ya kanisa imeanza kufika. Sawa. So I agree. When you check paragraph 1 up there, the profit was 360. When you check note 1 on 1st April 2019, just before the top up, profit is 860. So profit is what is changing, but ordinary is constant. So the changes in net assets is the profit itself. So parent will not take the entire, they will take 40%. So 40% of the 860 minus the 360. So you can say here, retained earnings. So what is 40% of that difference? That difference itself is 500. So 40% of 500 is likely to give us 200. No, my head is tired. Nyinyi mtafute. $200. Therefore, the value of our investment in S on which date? 31st March 2019 is 2,700. Yeah, that is 27. 1, 2. Who has a question? Tunafanya mpaka B, then now C tutaikujia jioni. Tutaikujia jioni. Bas, let's go to part B of the question. So B of the question, calculate the goodwill arising on acquisition of S as at 1st April 2019. 1st April is immediately after the top up. Immediately after the top up. So goodwill on acquisition. 1st April 2019. After the top up. Remember, after the top up, now it will be 70%. That is what you need to appreciate. So you will come here and say shillings are in how it's here? Shillings in millions, shillings in millions. How many marks in the first place? 4 marks. Okay. So you will come and say purchase consideration. Purchase consideration. So purchase consideration will be divided into 2. You know, initially we had invested in that company. Angalia huko juu. The consideration was 2,500. Remember, consideration was 25. But you see, 25 was the original in 2013. Now they want us to calculate goodwill in 2019. So you cannot consider this 25 anymore. You check this 25, it has gained value to what? Because lazima ikuwe ikisonga kidogo. So go to additional information number 1. I'm really involving you in this question. Go to additional information number 1. You will check this previous investment, it must have gained value to a certain figure. So can you check? Just check that note 1. You will be able to see it somewhere there. So I'll call it fair value of previously held investment. Somebody, it has increased value to how much? Because 25 was in 2013, but now they want us to calculate in 2019. That 25 imesonga. Ima, Vera and the rest, yes, 3,000. When they figure 3. So the previously held investment is now 3. So when calculating goodwill in 2019, you will use the 3 because it was 25 when it was associate. We don't calculate goodwill when it was associate. We calculate goodwill when it's a subsidiary. So it's a subsidiary, you check the investment which was there when it was associate. Right now, it is how much? It is 3,000. Correct? I agree. 3. Then, for the 30 you are topping up, you will also be required to add something. So check for me again in note 1. So fair value for the additional interest. So for the top up of 30%, the 30%, they are required to pay how much? Mercy, 22. I agree. Can people check note 1? For the 22, wanaistahili kuongeza. For the 30%, sorry. For the 30%, they are required to top up 2,200. Like that. Then you add fair value of noisemakers. I don't know where it was stated. It is stated somewhere there. I hope our noisemakers order to bear stress. So stated, check note number. Which note? Note number 3. Check additional information number 3. Go to additional information number 3. In note number 3, they said the group's policy is to measure the non-controlling interest at their proportionate share of net assets in the subsidiary at the date of acquisition. Hapo sasa umetupeleka safari nyingine. Proportionate share is 30%. 30% because now parent will be having 70. The 40 previously held was 40. So the 40 plus 30, 70 for parent. So proportionate share of noisemakers will be 30%. So 30% times, they have said we multiply with the net assets on the date of acquisition. So we don't have any option but to get the net asset on the date of acquisition. So have a working candle from presentation for net assets on acquisition. On acquisition is now when it became 70% because minorities in the subsidiary, so it became 70. So we are going to take ordinary share capital, retained earnings. We stop hapo kwanza, but naona zingine mbili hivi. So let's pick those ones first. Let's pick those ones first. So this one here, ordinary remains 5. Retained earnings, you take on the date of acquisition. On the date of acquisition. On the date of acquisition, when it became a subsidiary, not 1, 860. Check additional information number 1. When it became a subsidiary, that is 860. But also, there is revaluation. There is revaluation. Revaluation is coming up in note number 2. 2 bullet 1 and 2. So when you check note number 2, an item of plant whose fair value exceeded its carrying amount by 150. On 1st April 2019. 1st April 2019. So there is revaluation of plant 150. Then bullet 2, on 1st April 2019 again, the directors of H Limited identified that S Limited had internally generated database for customers. A lot of stories there. But that database has a value of 90. Where they have kusoma? Database. You know, database is an intangible asset. Internally generated. So we have those two. We have those two. So can you add? Those are the net assets of the date it became a subsidiary. There was plant and there was database, worth 90. So can you add the 4 and give me the answer? What do you get? People are getting 6,100. Thank you. 61. So it is 30% of 61. They say their fair value is the proportionate share of the net assets on acquisition. So net asset is 61, so proportionate is 30% of that 61. How much is 30% of 61? $1,830. So the total will be how much? This plus 1,830. What will you get? You get 70, 30. Less net assets. Net assets acquired. So net assets is the 61. Ningeweka straight lakini nataka kupata max. When it is required, you humble yourself. Usiweke tu 60. Kama ingekuwa required ningeweka minus 61 straight. But again, we use all this. At least you can get some tips. So Ordinary share capital. Ordinary share capital, 5,000. Retained earnings. Retained earnings, 860. Revaluation. Revaluation, plant, 150. Database, 90. Total, 61. Goodwill, the difference. So how much is the goodwill? How much is the goodwill? Goodwill have been given to be 930. So goodwill is 930. Thank you. 4 marks will be 1, 2, 3, 4, 5, 6, 7. Any 4 at 1. So unaona umeleta 61 hapa, ingekuwa 1, 2, 3, 4. It can limit you. It can limit you because this revaluation you can forget. So if you forget revaluation, unaona utakuwa umepoteza marks. But wewe kama ni wakurusha, hata ungepata hiyo 1, 2. Hata kama hiyo zingine ni wrong. So we'll talk about it. So it's good to list them. So for the remaining 7 minutes, we cannot do the balance sheet. So let's do the balance sheet in the next class. Yeah, let's do the balance sheet in the next class, which is 6 p.m. So let's meet at 6. We do the balance sheet. I see what next. Otherwise, we are very good. I'm sharing with you how I intend to cover the syllabus today. Thank you. Have a nice day. When you're in kanisa, pray for those who will not manage to. Otherwise, thank you. You can log out if you are done.